Everyone, thanks so much for joining. My name is Denise Loria. I'm the Special Projects and Operations Manager at AFC. Today, we're thrilled to bring you today's webinar on debanking, and it's in collaboration with our legal advisory member, Jenner and Block. We have a great panel in store for you. Just a few quick housekeeping notes before we get started. If you guys have any questions, feel free to drop them in the chat or the Q&A feature. We'll do our best to get to them. As a reminder, this webinar, it does provide one CLE credit. We did send out an email about 3 hours ago with the CLE instructions. So if you have any questions, I'll drop my email in the chat and feel free to reach out. So without further ado, I'm going to pass it over to Jeremy from Jenner and Block, who's going to kick off the dialogue.
Great. Thank you so much, Denise, and thank you to AFC for hosting us and being such a great partner. We have a great panel today. I hope you're all excited about discussing debanking, which is the topic of the day. If you're not interested in debanking, this is not your webinar. So you're in the wrong webinar. So I'm Jeremy Creelan. I'm a partner in the New York office of Jenner and Block and co-chair with my partner Laurel, who's also on the panel of our fintech and crypto assets practice. And I'm delighted to welcome you today. So let me do some quick introductions of our panel, and then we'll jump in. So first, Chris Sidler from FS Vector. He's a partner and head of advisory at FS Vector. And Chris advises financial services firms, fintechs, and their bank partners, focusing on regulatory compliance, risk management, and product development. He has particular expertise in AML and economic sanctions. And before joining FS Vector, Chris was managing director at Berkeley Research Group, following over 13 years at IBM's Promontory Financial Group in the UK and the US, where he co-led the America's financial crime compliance practice and helped build and operate the firm's RegTech and managed services affiliates. But most important, Chris used to be a race car driver and racing instructor. So he has promised me that this will be an interesting and fast-paced panel. So welcome, Chris. Next up is Karin Lockovitch. Karin is a partner and head of consumer and retail banking compliance in Oliver Wyman's finance and risk practice based in San Francisco. She has over 25 years of experience in risk and compliance within the banking and financial services industry. She covers almost every area, so I won't go through all the different areas. But before consulting, she spent more than 20 years in risk and compliance roles and as chief compliance officer in retail banks, including Bank of the West, Zions Bank Corporation, and SunTrust Bank's Consumer and Small Business Division. Welcome, Karin. Next up is Ian Moloney, Chief Policy Officer at the American Fintech Council, our partner today. Ian knows more than anyone on the panel about what's happening in DC on the issue of debanking, among other issues of interest to AFC's membership. He spent years at the General Accounting Office analyzing policy and will bring his DC perspective and knowledge of the debanking issue to the panel. Welcome, Ian. And last but not least, my partner and co-chair of our practice, Laurel. Laurel is uniquely suited to address this issue as she has an extensive experience and career in government and private practice in both consumer protection and anti-fraud, AML, financial crimes. She was a DOJ in financial crimes and prosecuted the first digital assets case in our history. She was the deputy director of enforcement at the CFPB. And in private practice, she counsels fintechs, banks, and cryptocurrency companies in AML, BSA compliance, anti-fraud measures, payments, product counseling, among other regulatory issues, and also represents them in government investigations before state and federal agencies. Welcome, Laurel. So with that, I'm going to ask Laurel to give us kind of a quick overview of the debanking issue and some of the recent regulatory developments. Laurel?
Yeah, thanks, Jeremy. Hi, everyone. I'm going to try to do this relatively quickly just to set the table to make sure everyone knows sort of what we're talking about in terms of a background, and then pass back to Jeremy so we can get a discussion with all of our panelists. And we'll provide this deck, so you'll have the details. I won't, go through everything in the great detail that's on the slides. But to start, here we have some information regarding the state of crypto regulation. And obviously the debanking issue is not entirely about crypto, but crypto has been one of the drivers. So to start, I want to just revisit some of the history here. Until 2025, the OCC, the FDIC, and the Fed all had crypto-specific pre-approval or non-objection requirements related to crypto activities. And you can see in the bottom bullets some of the things that were expressly permitted under prior OCC guidance, consistent for all three of the regulators, but that included crypto asset custody services, holding deposits to provide stablecoin reserves, and various other crypto activities. Those were all allowed, but only subject to express approval or non-objection by the regulators. And then in 2023, the three agencies issued a joint statement expressing their heightened concern about risks related to crypto, and that followed the FTX matter. So what happened last year, almost about a year ago, is the OCC published a new interpretive letter, essentially rescinding the prior guidance that required non-objection or approval, and allowing banks and other institutions to engage in the crypto activities that were expressly permitted. Since then, the FDIC and the Fed have both issued similar guidance. So we're in a new state now allowing this type of crypto activity. Next slide, please. At the same time, about a year ago as well, the OCC issued a new guidance related to reputation risk, and we're going to be talking about that throughout this discussion. And so essentially issued guidance saying the reputation risk should no longer be a factor in its examination reviews, should not be used as a matter for examination. Shortly after that, a few months later in August, the president issued executive order that's shown here, directed at ending what's called politicized debanking. And so that executive order directed federal banking regulators to fight against what it characterized as politically motivated denial of banking services. So the order asserts that banks have denied services based on things like political views, religious beliefs, or other lawful activities, and not based on legitimate risk factors. The order refers to Operation Choke Point, which was something that started back in 2013, which aimed to use the banking services as an opportunity to choke out certain illicit activity, as well as post-January 6th surveillance programs were cited in the order as a basis for this debanking push. So after that, then the OCC and FDIC jointly issued a notice of proposed rulemaking to codify the reputation risk removal. Federal Reserve just issued its own rule, what is it, the 26th, earlier this week. So that has moved along. Next slide, please. At the same time, a few months ago, well, I guess it's actually a couple months ago in December, the OCC published preliminary findings of a review that it has started of 9 of its largest supervised banks relating to potential debanking activities. And so this, we've listed here some of the things that the report is reading out on. It's a preliminary report. It involves a review of documents from the banks themselves, as well as consumer complaints. It does refer to potential referrals to the Attorney General if there are instances of what it considers to be improper debanking. It does not address the fact that things like crypto activities were not that long ago subject to heightened risk and pre-approval, so it does not address that issue. Next slide, please. In light of the debanking and reputation risk guidance, I wanted to also flag this other piece of guidance that came out a couple months ago that refers to the privacy rights of financial institution customers and advises institutions to limit their filing of voluntary SARs, essentially to where it's just a matter of something below a threshold, but essentially warning against using voluntary SARs to report on activity that might be of the type that's covered by the debanking issues. All right, next, maybe skip 2 more slides, and I just want to briefly point out some of the fair access state regulations that have come into play at the same time. I'm not going to go through these in detail, but again, you'll have this. There's a few slides here, and perhaps we can skip a couple more slides. There's a chart. There we go. It shows you the 3 states that have thus far enacted fair access regulations are listed here. Tennessee and Idaho have rules that are more focused on larger financial institutions, but There's a movement more broadly in other states to do the same thing. So with that, that's sort of the background to some of the questions that Jeremy is going to raise. Thanks.
Thank you, Laurel, for that overview. And you all have the deck. I should have also mentioned we're going to give you the CLE code farther into the program around 1:30. So stay tuned for that. So let me just continue with the sort of regulatory landscape for us for the moment. And Karin, let me just ask you a question. So building off the December OCC report that Laurel discussed, what are the key things that banks and other financial institutions what should they take from that December report, and what should we expect next on this topic on the regulatory front?
Yeah, I'd say let's kind of give my reaction to the report. I'd say generally, generally I was surprised a bit by the tone of the report and the somewhat, I'd say, capacious interpretation of debanking in the report. While the executive order earlier in the year was specific about the need to not restrict banking from customers engaged in lawful business activities. In a number of speeches over the fall by Jonathan Gold, he had made it clear that there are sound business reasons why a bank may choose to not do business with some industries or sectors. That said, the report was heavily focused on industry sector exclusions. It was a big focus of the report that they issued, and particularly those that were related to the institution's ESG and sustainability objectives. And so I suspect, that they focused on some of these more obvious examples, perhaps in part because they didn't find, material number of other debanking actions outside of these and outside of the January 6 events. I think this also suggests that exclusions driven by reputational risk and/or ESG climate-related motives will be perceived as debanking. I think that's important for institutions to take away from that report. A few other things I'd say I found notable. They indicated concern about collaboration with federal law enforcement as potentially violating the right to financial privacy law. Although we know that that collaboration and coordination is specifically required in certain AML-related processes. They highlighted concern about heightened review, escalated review of some of these decisions as also synonymous with debanking, and which is this sort of counter to how we historically consider enhanced due diligence, escalation, and governance as actually a sound risk management practice. So that was very interesting. And then finally, as Laurel had mentioned, there were a number of mentions at the end of the report about additional action through CRA ratings, potential enforcement, referrals to DOJ. And I think there is an obvious kind of looming question as to the legal basis on which legitimate enforcement and litigation could be pursued. So more to come on that. I mean, it remains to be seen.
Thank you. That's a great jumping off point. I want to focus first on sort of the implementation of this, if that's the right word, the efforts to kind of read the tea leaves and implement the directives from the various prudential agencies. What are you seeing, Karin? I'll stick with you for a second, Karin. What are you seeing financial institutions and banks in particular? What are you seeing in terms of how they're, approaching the internal lookbacks, remediation, and the process changes that they are taking in response to the debanking, guidance? What are you seeing on the ground?
Yeah, and I'd probably bucket a bit. Certainly there were 9 banks that were subject to the RFI from the OCC that informed this report. They obviously had, a much more expedited process that they had to go through. Obviously, banks that have been subject to some of the state laws that Laurel had mentioned have already done a bit of this over the past couple of years that I think helped kind of smooth a bit of the path here. And then there's also the SBA. There's some requirements from the SBA that banks have had to react to. So there have been sort of pockets of activity happening, but I think generally I'd say four big areas that they're all kind of pursuing. First is just kind of operating model, like how do they cross-functionally project manage this? And we are seeing that largely led by legal regulations or risk function, but certainly cross-functional because of the nature of these activities. The second is the look back. So most are doing a 5-year look back. That's what was required by the OCC and their RFI. That's pretty customary when you think about remediation. So 5-year look back generally, we're seeing that. And with focus on a few areas. So kind of key customer activities, onboarding is obvious, offboarding exits is obvious. The third is sort of customer activities. The executive order talked actually quite a bit about payments. So there are some activities within the customer lifecycle that many banks are also looking at. Second is complaints. That is a big part of this, and the OCC's report highlighted this as well. Regulators are all looking heavily at complaints. Any of your an institution's sector, industry, customer level exclusion lists, you have these in the AML space. There may be other reasons why institutions have a list of customers or industries they don't do business with or will approach with a higher risk. Lots of institutions have closure committees, so reviewing closure committee actions and any exception, sort of escalation decisions regarding account opening and closing. So really evaluating those activities in particular. The third is remediation, and this is a little more complicated. The SBA and the executive order hit on this a bit, but effectively, where there are identified violations here, which let me just say, I think for the most part, institutions are kind of reporting back that they're not finding a lot of this. I think it's more kind of sector industry level, very few sort of exception based. But where they do, the remediation is challenging, right? Because these are people that may not have gotten an account or their account was closed, and so years later, you're now kind of having to offer up to provide them an account. So that's a little bit challenging, but certainly that's a step in the process. And then the fourth is go forward process changes, and we see a handful of things there. Certainly tightening underwriting and credit policy models, particularly as it relates to kind of reputational risk factors. So things that are not grounded in risk, in an obvious sort of financial or regulatory risk, and shifting, exclusionary lists to something more risk-based. Driving where there are exceptions or a need to kind of more closely evaluate something to a more centralized process or governance practice, but also standardizing and even limiting exception-based discretionary decisions, which you often see that in like commercial banking practices. So I'd say those are the biggies. Certainly document or strengthening documentation standards. And then, I think a lot of institutions are also implementing some enhanced complaint reviews, testing and monitoring practices. A lot of variation, I'd say, around, kind of where some of these enhancements are, and the extent to which institutions are implementing some of these enhancements, as well as I think some institutions may not look heavily at certain customer activities. Others are looking at this more broadly. And then we'll get to this later, but a lot of variation in how institutions are approaching the reputational risk piece of it as well.
That's great. That's a great overview. Chris, I want to turn to you for a second to talk a little bit about fintechs. They're obviously in the ecosystem now, with particularly those in bank partnerships. Their position here vis-a-vis debanking is a little murky. In some cases, they have no role. In other cases, they have the substantial role. What are you seeing in terms of implementation? How are fintechs approaching it? Are they approaching it? What are you seeing?
Yeah, thanks. And I'd echo your comments about Karin's overview. Just fabulous. I think there's so many points there that we'll be able to draw out throughout the rest of the conversation. So I'll do my best here to sort of piggyback off of some of that framing. I think when we think about the sort of fintechs in this space, particularly as it relates to debanking, sort of two broad buckets. I mean, there are those fintechs that have sort of built their business model or predicated their business around industries or segments and customer segments or industries that previously or heretofore had been considered to be traditionally high risk, or maybe those that may have been subject to sort of debanking or maybe never having access to banks in the first place as a result of that. And then secondly, maybe the broader set of fintechs that maybe at the margin would, if they could, serve those segments of the population that may be subject to debanking, but not necessarily sort of core to their business, but maybe incidental to it. But many of these fintechs, take their policy positions, the types of customers and products that they're able to offer, they take that direction sort of contractually through their bank partners in many cases. And as a result, sort of what those banks say, and Karin touched on it already, the sort of exclusion lists, for example, and here we're talking about which types of industries that a customer or prospective customer may be involved in would be involved in that decision about whether that customer should or shouldn't be onboarded, or whether its relationship should be maintained or not. And I think what we're seeing in terms of the implementation of this, the reaction to the debanking sort of discourse generally, is that it's been pretty uneven, at least from our perspective. I suspect Oliver Wyman and your team sees a wider range than maybe the focus at FS Vector. But certainly if you're in the digital asset space, I think your sense on the debanking, discourse over the past year or so has been generally a pretty positive one. And that, banks that previously thought about not getting involved in the crypto or digital asset space, or maybe were in it and then backed away from it, have since been rethinking that decision and now are actively looking at which ways they can best support that industry. But I think in other areas it's been less clear about what sort of impact has been felt. So areas like adult entertainment or firearms or some of these other areas that were like sector specific, highlighted in the OCC report, I don't think we're yet seeing like a significant change in the sort of treatment of them within the bank relationships, but maybe it's just too soon to tell, and that over time we'll see that open up some more. Very curious.
Can I ask a follow-up on that? Have any of you seen any regulatory sort of focus on fintechs in putting pressure on them to address debanking with their bank partners to make sure that that it's happening? Or are the fintechs pretty much so far kind of insulated from it?
I think we've seen specific instances, not so much in the digital assets. I think let's set that aside for a second, but take maybe some specific examples like a fintech that wishes to support a diaspora community, and as a result, there's like significant remittance or some exposure to the sort of home country. And then previously, not unlike the exclusion list, each of these banks would have their own view of geographic risk. And so they typically have like a map of the world and say, well, this country is high risk, this one's low. And historically that view would have been, well, that's a high risk country for AML reasons, or it's a high risk country because of exposure to OFAC sanctions or something else. And I think what we're likely going to find is that those judgment calls that had been maybe held out previously to be just sort of truths held by that bank are being challenged at times. And so we're seeing that level of discussion play out. And it tends to be a positive, sort of interesting two-way discussion about whether, this community is in fact high risk, and whether remittances that involve a certain, channel or direction, actually do pose the sort of risk that maybe previously would have assumed them to have been.
That makes sense. Laurel, I'm going to turn to you. What are you seeing in terms of implementation and the lessons that are being drawn from these regulatory pronouncements?
I will say Karin did such an excellent job of covering everything, and I'm better than I could have. So I'm going to focus on one thing, which I don't know if I'm seeing it, but I would like to see it. And it's something I talk about with everyone who will listen to me on the debanking topic. And that is thinking about your interaction and policies related to government requests, formal and informal. And I've been on both sides of this. Former prosecutor, obviously, issued many subpoenas to financial institutions. I work with clients all the time in responding to subpoenas, freeze orders, keep open letters, various other types of requests, and work with compliance teams who have very proactive, cooperative, collaborative relationships with law enforcement. But I think that to some extent, we know this from work we've done with some financial institutions, that is where people can get a little bit into trouble. In the sense that over cooperation outside of legal process can create a record that in certain lights, as in this moment where we're talking about debanking, looks like sort of an overextension of restriction of access. And so what I recommend to folks in light of the debanking requirements is that they make sure that their policies and procedures regarding responding to government requests require formal legal process before providing information. And obviously, I mentioned the voluntary SAR guidance. We see some other signs, FinCEN's other guidance regarding SARs, not really a change of law, but a sort of drawing back of expectation to some extent over SAR filings. And so when it comes to good compliance teams, there is a natural and good tendency to want to aid law enforcement in the sort of joint fight that the Bank Secrecy Act requires against, illicit financial movements. But the legal process, requiring a subpoena, requiring a seizure warrant, before you turn over financial information is there for a reason. And so I think it's very important. It's sometimes an focused on, overlooked piece of this debanking issue, as far as I'm concerned, which is to really look at that and train your folks to make sure they know that even though it may feel helpful in the moment, it may not be helpful to anyone in the long term and may create some risk.
May have different parts of the federal government having different views of how to deal with this issue. Ian, I want to give you a chance. Chris had raised the issue of different, particular focus of fintechs or otherwise in, serving immigrant communities or particular industries. What are you seeing? Because you have a real unique view of the membership of the AFC. What are you hearing and seeing in terms of how the debanking regulatory pronouncements are affecting specific companies in specific sectors?
Yeah, I think Chris did a really nice job of laying out the issue and kind of what's being seen across the board. I know the folks over at FS have a good sight line for sure, but within our membership and I think within some of the broader market, we've seen that there's a general approach that has been taken as far as making sure that if you're going to be engaging in certain activities that you're documenting why you're engaging in that. And that goes back to, I think, even the previous administration and before, it was really this conversation of debanking, but more in, the broader umbrella of de-risking and that aspect of making sure that you're ensuring, good objective, neutral criteria are being applied to, why you're engaging in one activity or another. But then there's also, definitely the political end. And so for different fintech companies that may be engaging, specifically with immigrant communities or, heavily in digital assets, I think some of those tides, they're recognizing that it's more of a shifting political winds, and that's creating either where they need to ratchet up that focus on having that objective and neutral criteria, making sure that they're preparing sort of for the regulatory inquiries, doing the training that Laurel had mentioned, and additional training too of how they're making sure that their decision makers are not doing anything discriminatory as far as opening or closure decisions, and then the robust record keeping I think is really important. So as fintech companies and their bank partners are engaging in specific activities for specific groups, they're trying to tick off all of those boxes, generally speaking, and then more on the specific side is how much do you need to ratchet this up, or can you kind of take the political winds as they're shifting in your favor. But ultimately, there is a need to recognize that this conversation around debanking is an inherently political conversation, and so any future administration may have a different view on it. And so that's where I think it's important for all the institutions to make sure that they're keeping this record keeping, they're doing the documentation really effectively, so that way you don't run into a secondary and the next administration's look back period on your examination and have to answer some really difficult questions.
Yeah, the ever present value of documentation. We talk about that constantly. Let me pause for a second and give folks the CLE code, and maybe Denise, if you're there, you could put it up on the screen too. It is JB30922. Again, JB30922. Great. So let's shift gears a tiny bit to just talk briefly about reputational risk. Karin, I want to ask you, there's been all this talk about reputational risk and removing it on the regulator side from the supervision process. I'm curious, in your experience, how significant was reputation risk in the bank compliance and diligence programs leading up to this, before any of this in the current administration? How significant was reputation risk in those programs?
Yeah, it's a great question. Because I think there's the difference between kind of the reality and perhaps a perception. But in terms of how significant it has been relative to decisions to bank or not bank customers, like in the context of debanking, I would say it's been pretty minimal and largely a sort of one-off and exception based. Outside the U.S., I'll draw this distinction. It has been given more importance in kind of customer level risk underwriting decisions, due diligence. Non-U.S. regulators have placed, I'd say, more than the U.S. More importance on reputational risk as they look at customer level risk. So I think that's important to note. But in terms of the level of importance it's had to risk management generally leading up to this point, I'd say over the past decade, it has been given increasing and material weight. And there's certainly been a desire by institutions and by regulators that reputational risk, and even more generally, I'd say risk to brand and shareholder franchise value, which I think a lot of institutions prefer to use now, be given meaningful consideration as part of strategic planning and strategic decision making, and as they kind of monitor the external environment. I'd say that's been important. It's been important to institutions. And we'll probably get to this, but I also think that outside of the banking, debanking conversation, it remains an important consideration for institutions, and perhaps even with regulators.
So picking up on that, I mean, given, especially since the pronouncements by the regulators have really focused on their own practices, how are banks supposed to respond to this change, the removal of reputation risk in the supervision process? How are they supposed to respond, and how are they responding?
Yeah, this has been very interesting. Rep risk has gotten a lot of attention through the debanking conversation and more broadly, right? And so it's gotten a lot of attention, but you're right. Like, the focus has actually been very much on the regulators themselves and the regulators' own practices. And to their credit, I think they're holding themselves accountable here. And there's actually been, again, outside of the debanking conversation, very little directive to banks or even non-banks, the financial industry, in terms of what they should and should not do relative to reputational risk, again, outside of the debanking conversation. So it has been interesting to watch how institutions have reacted to that. And I would tell you there's a lot of variability. I know of very comparable banks in terms of business model and size and risk profile and regulatory regime that one has removed reputational risk, any reference to it entirely. It's no longer a risk stripe. It's no longer in their taxonomy, or they've kind of buried it a bit more in the taxonomy. They no longer have a reputational risk committee. They've kind of absorbed that into something else. They call it something else. A lot of institutions have renamed it to brand, franchise risk, things like that. But underlying it, they will probably tell you that they're still thinking about it. They're still paying attention to it. I've also talked to institutions, very similar institutions that have done almost nothing differently aside from pulling it out of credit underwriting, policies, models, et cetera. So I think this is an area that there is a lot of variation across the industry in terms of reaction to this. And frankly, it would be great to get more clarity as institutions work with their exam teams from the regulators themselves on what they expect to see, what they want to see. I think there's also I would say a political dynamic around this that institutions are trying to manage too. And so it's also not uncommon to find boards, et cetera, that are mindful of that and want to avoid, particularly in a period of time where there's a lot of M&A pursuit, et cetera, where they want to stay out of the crosshairs. And so they want to avoid topics that are going to be triggering in some way. So they're pulling back from that, even just as a term.
Yeah, in a strange sort of way that almost everyone on both sides may be served by the vagueness of of the directive. If it gets too granular, it's very hard to figure out how to manage it. So, Chris, let me just ask you, what are you seeing in terms of challenges on the reputation risk front in terms of implementing that?
Yeah, I mean, very similar. First of all, I would say no good deed goes unpunished. And if I can, again, play back a little bit of what I heard from Karin earlier on in the conversation, and by all means, Karin, correct me if you think I misinterpreted, but what I found curious about the most recent report and some of the discussion around it has been sort of taking those processes that we would typically have held out, those of us who have been working in this industry for decades, as being sort of foundational to like good risk management, like the escalation processes, those things that to a large extent should be the ones that help to prevent the kind of outcome of a debanking or any other sort of negative outcome for the bank or for the consumer or the community. And I think it remains to be seen the extent to which, sure, we've may remove reputational risk consideration on the examiner side, but to the extent that those processes that are meant to sort of take over the risk management on the regulated side of the equation, and if those processes, robust as they may be or may have been, or maybe they need to be enhanced in certain ways, the extent to which they are themselves under scrutiny and maybe left to be sort of thrown out for fear of being seen to be overly debanking-esque, even if their ultimate aim is actually quite the opposite, or should be maybe the opposite. And so again, I think that's an open question right now, and I'm curious to see what the next few months looks like on the bank side. But again, would invite the rest of the group to comment on that, because you will have seen it as well.
So, Laurel, I want to turn to you just on sort of picking up on these risks and challenges. What are you seeing as the key risks and challenges in terms of implementing this?
I mean, we've talked about a bunch of them, but I think the thing that I'm going to is really the opportunity to do more on identifying what the specific risks are here. In the last administration, there had been this sort of growing focus on risk assessments, particularly for novel products, and sort of getting, more particularized on risk assessments. And we're not hearing about that so much these days, but what we're talking about is sort of a consequence, I think, to some extent, of over general risk assessments that have existed. And my perspective, is from coming in after the fact, usually defending the risk assessments and compliance programs either in a supervisory matter or regulatory matter or with DOJ. And so, take it with that grain of salt. But from my point of view, I think that there's more work to be done on the risk assessments themselves, and that is part of the defensive work to do on the debanking issue. So to the extent that that the risk assessments don't look rote, which many of them do, particularly as new products come into place, those risk assessments have to be refreshed. They have to be product specific. They have to be customer base specific. I mean, those are all inherent in a risk assessment, but from what I've seen, a lot of times it's more general than one would like. And even the debanking executive order and the other guidance, says you don't have to serve everybody necessarily, but you have to be able to articulate why you're not. And it can't be just on a sector by sector, we're not going to do this type of work. But so if you've identified a particular risk and you don't have the compliance resources to control for those risks, that might be, and you can again document it, and we talk about that, then, that might be a perfectly reasonable thing not to do, because the risks may demand a certain level of staffing or sophistication or training or whatever it is that you may not have or want to invest in. And so I keep coming back to, what are the opportunities in the risk assessment process to be more specific? And that does take an investment of time and resources, because you have to then update and make them more of a living document as things change. And that's hard. But that's what I focus on when I think about trying to defend, decisions in this space at this point in time.
So just extrapolating, it may be that substantively you're optimistic that there's not sort of going to be undue pressure to bank folks, certain customers that shouldn't get services. It's more a matter of just as long as they're
optimistic may be too strong a word.
Maybe as long as there's sufficient documentation of a more specific risk rather than a sector, a sector-based or geographic or something that's less fulsome.
That's what the guidance says. Now, doing an individual, obviously there's customer risks, there's customer due diligence, risk score rating, and all that happens on a individual customer basis. But, doing some of this on an individual customer basis is extremely burdensome and very difficult to do. So there's definitely a line to be walked here that I'm sure everybody is trying to do right now and trying to figure out what that is. But yes, I'm suggesting that one of the protective pieces may be to look at, that risk assessment and have, obviously multiple risk assessments, which you do for different products, and think about that as your foundational piece as you're making these decisions.
Perhaps AI can produce some efficiencies that allow resources that are, to free up some resources for that. Let me ask you, Karin, what are you seeing any particular unique challenges that faced by FBOs or global institutions rather than just domestic as they try to implement or respond to these requirements?
Yeah. I think it's particularly complicated for them. I mentioned this just briefly before, like particularly as it relates to reputational risk and maybe I would say even more so some of the climate ESG dynamics, which are still very, very important in non-US geographies and remain really important. I think the fact that the OCC, I think even included links to a lot of the banks that they had looked at in their preliminary report, links to their sustainability reports and their ESG related reports as kind of further evidence of debanking activity, I think really highlights that tension now that global banks, foreign-owned banks are facing. Because that, like I said, that remains very important to their strategic planning, to how they manage their banks, and frankly how regulators outside the U.S. Look at them. So I think that divergence is growing and and challenging. I think we have a little bit of it in the US, just with certain states, I think, taking some stronger actions around some of these topics. But, we still have a few states that are still very active in climate. But it's far more pronounced outside the US. And it does require these institutions to give up some efficiency, give up some standardization to try to meet these geographic specific needs. And unfortunately, there's not really easy ways around it right now. But that is a real complexity for those institutions.
Thank you. So I want to shift gears in our last few minutes to really focus on sort of recommendations, more concrete or lessons learned or advice for some of the folks in banks and fintechs in this ecosystem. And let me begin with you, Laurel. I know you've already talked about the legal process in terms of responding to government requests. Are there other pointers or things to focus on that you would recommend?
I'll mention just a couple because I've already talked about a couple of them. I have my little sort of debanking defensive plan that I talk to people about. And of the things that we haven't talked about already, I would add, really being aware of and reviewing your marketing and customer disclosures and what they say. So being clear on what it looks like to the public, because a lot of this is managing that attention, managing inquiries, managing customer complaints, and that sort of thing. Using your data analytics, this feeds into what I was talking about before, to define your risks so that you have, evidence. If there's a question about why you are not doing, or serving a particular sector or type of customer or whatever, you've got data to back it up. And then obviously, complaints handling is always important. Review of customer complaints is a big part of what the OCC and other regulators are doing now. Obviously, banks and other financial institutions are already looking at and mining their customer complaints as they should be for a variety of reasons. But that's always something that's hard to do and always needs more attention. AI is, I think, a real help in that area these days. But doing it with this lens in mind are the things that I would add.
Great. Let me turn to you, Chris. Do you have some recommendations from your work that you'd share?
Yeah, I mean, I think several of them are ones we would have touched on already in the discussion. But I think at minimum, I would suggest to our clients to take a look at the full suite of their compliance and risk management programs, from the sort of foundational document level materials through the sort of frameworks and methodologies that help to sort of articulate those policies into their practices. So how do their risk assessment, how are they constructed? Where's the human qualitative element? What are the quantitative inputs to these? How do they work together? What other judgment calls, are made throughout the articulation of that compliance and risk management program? And how should those be sort of distilled down to, if previously we used the term reputational risk, but in fact we meant something else, like maybe there's some other precursor to that, like it was in fact a BSA/AML issue or an OFAC issue, but we called it reputational risk, and we need to like rethink about how we categorize that stripe, then do so. And when that process is done, or at least on its way towards being done, think very carefully about where the investments across the program need to be adjusted to be commensurate with that sort of reestablished sense of the risk profile and the exposure that the organization is set up against. And so that could mean things like investments in transaction monitoring or enhancements to a complaints handling process, or any part, the onboarding and underwriting of a customer process and the offboarding process. But any one of those areas that may be pressured because of a change to the way in which the organization has begun to sort of redefine the risk exposure is something that they shouldn't forget. It's not just a documentation exercise here, it's also the articulation of that program in the real world.
I mean, hopefully,
Jeremy, can I add one? As Chris was talking, it made me think of something else that I wanted to add to my list. I'm sorry to jump back in, but we talk about Bank Secrecy Act and AML all day long, as we should, but just straight out money laundering is another sort of important thing to think about. A financial institution cannot conduct a money laundering transaction. And so thinking about your anti-money laundering policy outside of the BSA in particular, meaning if you have evidence that something is illicit activity, and that may come into play when you're talking about sort of international transactions as well, because other countries have other laws, and that can be a basis for a money laundering charge here in the US even. That may provide another sort of bulwark against the debanking claim, because a bank cannot be required to use its account services to conduct a transaction that does actually involve illicit funds. And with that, I'll step aside, but thank you.
That's really helpful. I mean, I think obviously struggling with what is evidence is part of it too. I think that hopefully the kind of review that you're talking about, Chris, can be done in the context of looking at these not just because of debanking, but also, a more holistic review that incorporates, other aspects, because it's a lot of resources to devote just because of the debanking issue. And I'm interested in sort of how practically this is being integrated into other reviews and other, updating policies and processes, rather than, just being its own kind of resource, consumer. Karin, let me turn to you on recommendations and experience on this.
Oh yeah, I mean, you guys have all shared great ones. So I'll keep it maybe more broad, but I'd say do the work. I think like Chris said, if you've not done it already, do your historical review, get ahead of it before the regulators take a look at it if they haven't already. Complaints are, they are the easiest thing for a regulator to grab and run down, and they do. And so, any institution should be well ahead of that by monitoring their own complaints. That I think is a great suggestion. Talk to your exam teams, talk to your regulators. I do think there's a little bit right now of a sort of a lag between kind of the regulatory agencies and perhaps the exam teams in terms of how to implement and action this topic in particular. But, really aim to kind of leverage the relationship you have with your exam team and get a sense of what their expectations are and how they're going to be looking at you and what you need to be doing. And then I'd say the last one, which somebody mentioned earlier, is like, don't overcorrect. It's kind of hard to do right now in this environment, but kind of where to kind of walk that fine line. But this is an interesting topic, and I think is one topic that is very subject to a snapback under certain conditions that could easily arrive. So I think being really mindful about how much you react to some of this, and trying to balance that.
I think we may have lost Jeremy. I don't see him here. But I'll jump in until he joins back. But Karin, I think that last point, and I'm not going to dwell on it because it's more, it's a really important point. Things change, but it's a tough one. But I think it's worth thinking about, like, how do you sort of find that middle ground that's defensible both now and in the future
Yes.
is a real challenge. But generally, this is where, we say, if you show your work, and regulators either now or in the future have something to come in and look at it and say, well, there was a thoughtful reason. They often don't substitute their own judgment if they can see something in writing. It's where there's an absence that they can jump in. So I maybe give Ian a chance to jump in if you have other
Yeah,
thoughts
no
you wanna
worries. I think this is the benefit of being on such a good panel, is that so many seriously good points have been put out there. So I'll just kind of underscore a couple from our perspective. I think, looking at, maybe it's not the longest history of bank fintech partnerships, but there's still a history there. Reputational risk has had sort of an outsized role. And so to Chris's point of, institutions kind of rebranding and rethinking about this, it doesn't necessarily go away just because the terminology changes. I think for our institutions, they're focused more on what activities as opposed to maybe, where before it was just, oh, this entity, this, fintech partner, they've had a lot of, press articles or things like that. Now it's more of, well, what's kind of underpinning that? Are there actually, bad activities that might actually necessitate not onboarding them? And then, secondarily, I think the point that was raised regarding that these are political actions as far as, the political folks that are in DC are the ones saying, hey, we're going to remove reputation risk. We're going to, really focus on debanking. But these issues are being applied by career staff at the examination level. And so thinking about how there may still, within the broad scope of examiner discretion, how these sort of activities may or may not be applied in a uniform or disuniform manner, I think is important to consider. And then lastly, I know, and I say this to our members all the time, you have to mind the politics. And so whether it's this snapback that we might see, because elections have consequences, or even just, thinking about how, from a government relations standpoint, an institution might get caught up in the crosshairs of a political activity due to, the more centralized focus of this current administration. I think all of those are important when thinking about either onboarding, individuals or companies, or even, engaging in certain sectors. And so that's really, I always say mind the politics, because there's a lot here that is very political.
Yeah, and to that point, Ian, in our last couple of minutes, I wonder if people have thoughts. I mean, obviously the banks are regulated on the federal level. State regulators are in the mix too, particularly when you've got non-banks that might be partnering with banks. The states, I know from the work I've done with state regulators, reputation risk is a huge issue. And there may be, states are not necessarily super excited about everything the federal government is doing at the moment. Do people have thoughts on how that may play out?
I'll just jump in quickly first, and thinking about how the market is structured currently with regards to bank fintech partnerships. These are state chartered, generally speaking, state chartered institutions. And so the various states and their regulatory structures definitely have a role. And then even, factoring in especially the non-bank aspect, there seems to be, potentially kind of disparate views of what should be the focus of safety and soundness, and how is that standard, that principle being applied. And so I think you're right on that there's definitely a need for, especially the banks that are innovative in this space, given that state quality, they have to be paying attention to it across the board.
Anyone else want to weigh in, or should we leave it at that?
I like that. I like his response. I agree. Yeah.
All right. Well, I'm sure there's a lot more thoughts we all may have, but maybe for the next webinar. So with that, I think we've come to the end of our time, and on behalf of Jeremy, whose computer died on him, thanks to the panelists. This was a great discussion. Thanks to AFC for hosting it. And if anyone has follow-up questions, we'll try to answer them. I'll have a great day.